All right, checking back in. It is 10:53 a.m. Central Standard Time, Friday, March 10th. I was just downstairs in the basement checking in on some Aaron Rodgers news, seeing if there's any updates. I am a lifelong huge Green Bay Packers fan. In fact, my name Bart. Well, if you know anything about the Packers, then you know whom I'm named after. So if you do, go ahead and leave that in the comments below. But taking a look at Blackstone, I think we got a little work to do. We might roll some puts on this and also sell some fresh puts. It's been getting beat down the last couple of days. Financials are in the doghouse. So across the board, the financials are in the red the last couple of days. In fact, we got some trade work to do to try to manage through some of that. So let's take a look here, and you can see what's going on today with the portfolio. At one point I was down over $15,000 and then was up over 2,700 and now down again 4,500. So what's that? If we went from 1,656 to one almost $20,000 range bound right through there. So it's back down again, Bart. You're taking it on the chin right for the weekend. So let's just look through what we have. Let's start at the top. So right now we only have three things expiring today. The AbbVie calls, we have two contracts on that 160. It's not hitting 160 today, is it? So not much left in that trade. And I thought, I could let it expire in full profit today, or I could roll it now and catch a little more action through the weekend on the theta decay, on the time decay, because time keeps on slipping into my favor when the trades, of course, are going in my favor. And the opposite is true when they turn against me. We got the Qs. It says it's at 100% profit, but if I clicked through that, tried to do that earlier and the internet was not doing well, it would still cost us $1 a contract. If you see right here in the bid and ask, it still cost me $1 a contract, which would be $5 bills to get out of that trade. So we'll just leave it. We'll leave it to continue to expire at full profit instead of spending the $5 to get out of it. Now, is it possible that the market has a crazy rally and the Qs, which is based on NASDAQ right here, goes bananas? Of course, it's possible. Anything's possible. That's what Kevin Garnett told me in 2007 after the Celtics won the NBA championship. But just look at what SPY has done today. It's been a wild ride. Woo-hoo, all the way up to the top of the Raging Bull at Great America. They're at 393.09. Those are the moments where you're like, why did you buy out of that Iron Condor and spend all that money, $330, to get out of it instead of staying in the profit? It's because then the next thing that happens, Geronimo, all the way down to where we're at now, which is $390.37. It's down $1.21 today, 1/3%, even though those sweethearts over on the Dow, they're up 26 points today. So let's go back to what we want to try to accomplish here. Let's look at AbbVie and check on rolling this. We're going to have to roll it down to get any action, I would believe. If you look at AbbVie right now, it's at $149.55. A wonderful company. And they own that Botox with all that botulism that people like to inject into their faces. That trend isn't going to stop anytime soon. So let's see. We got two contracts. Let's roll it and just see what kind of action we can get if we roll this. And we're going to roll it down a little bit to get some action. And I was looking at the 157.50. So if we rolled it out 1 week, it would be 11 cents. Okay. So 11 cents, which of course in this regard would turn into a credit of $20 because we got $1 debit per contract, and there's two contracts. So that would be -2. Then it's +22 because it's 11-cent credit times 2. So then we end up with the math of a $20 credit. But I was like, yeah, what about another week out? Let's look at another week out. So it would be a 14-day trade. And then that credit goes from 11 to 36. So it more than triples right there. So I'm looking at this action here because if we go out even another week, so another 7 days out, it'd be a 21-day trade. It would go from 36 to or no longer are we able to get the 157.50. So we'd either have to drop it down to 155 or push it up to 160 with only a 34 credit. So I think we're going to roll the dice and take our chances at a 2-week trade and try to get close to this 36-cent credit, which would then put approximately $70 into our pocket. Now, we would be rolling down $2.50 a share. But I think AbbVie, it's still not going to trade into that number. So let's look at 34 cents and try to collect $68 credit, rolling this out. And there it is. So we rolled it out. We put $68 additional dollars into our pocket because, when we originally worked on that AbbVie, we had received a credit as well. So that is off the table. We then are left with the Qs and our SPY credit spread that we put on earlier. Both of those look good. The Qs obviously look really good. SPY had a little pressure on it earlier when it climbed up to around just over $3.93 a share. So it was actually in the negative at that point, but now it's rolled back down to $389.91, and we are at a strike price of $395. So we're looking in good shape on those credit spreads for today. And then the AbbVie, we just rolled that, but of course Robinhood isn't showing it yet. We have this Adobe Iron Condor for next week, and it is basically, it's on the lower side of the middle of our numbers because we're on the 310 on the put side and 400 on the call side. And it would cost us approximately $88 to get out of that trade that we put, what do we put in our pocket? 160 in our pocket. So we'll stay in that trade right now, see how Adobe does going forward. The Amazon 86 puts, we are currently at what for Amazon? $92.50. So it would cost me approximately $42 per contract to get out of the trade. And we collected $210. We're going to stay in that trade as well. But let's check it out down here. Let's check it out on the Bank of America calls. Okay, so Bank of America is all the way down here at $30, $30.57 right now. So to get out of these calls, what did we collect on those? We collected, we don't even know, do we? We don't know what we collected on those because we rolled those over from a different account. But it's only a couple dollar bills left in this trade because it's at 35. But you know what? I don't want to lose the shares. So we're just going to we'll just let that go for now because we might look at, do we have a Bank of America call on the table? I thought we had a 32.50. Guess I can just go straight back to Bank of America. Did I say call? I meant put. Do we have any puts? Oh wait, there's my average cost right there. So there it is. So we're at $33.90 a share. That's our average cost. Okay. And it's currently trading at $30.56. So we're in the red. We're in the red right there. So that those $35 on the call side would be into the positive. And, those were going to be called away just a week ago as far as what the share price was at. But since then, the financials have taken it on the chin. So let's see what we have. So if we look out at the puts here at 33, then right now, those are way in the money, right? So we're taking gas on those as well. But they're still 2 weeks out. So we're going to let that ride. And we could roll it out again, but let's leave it where it's at. I think the financials will retrace some of their big loss that they've taken over the last couple of days. Look at that. Today, right after opening, it was at 29.25. If I wasn't at the gym pushing around like granny weight, I would have probably bought up some of those shares right there at the Bank of America, but it's since rallied up to almost $31, come back down a bit to $30.59. So we'll just keep an eye on that. And since those puts are 2 weeks out, we'll let it ride. Since those calls are a week out and we don't really want to I don't want to have to roll down and out. I want to just see how this plays out for these $35 calls for next week. Now this one though, this one's this one's in trouble right here. The $85 strike price on Blackstone. Let's open that up because it's showing big time gas. Because Blackstone has been, where are they at? I had them up earlier. Blackstone is right here, and you see what they've done today. They've been on a wild ride, but they were at one point, I saw them just under $80 a share, and they rallied back up. They went up all the way up to over 85, and then they've taken the snow hill back down to where they're at currently, which is at 83.20 on the Blackstone. And we like Blackstone, but we don't necessarily want to own it right now, because if we look out at the Blackstone, their next ex-dividend day isn't going to be probably until May. Okay, so can we play it coy in the meantime? We'll see. I mean, we may miss an opportunity here to buy up some Blackstone at a low price just because it's being mopped up into the financial wreckage that's going on. Or it could just be the tip of the iceberg and people start making runs on some of these banks, and then that really puts a damper on all the institutions that are involved in, what could be considered financial. And Blackstone would be considered one of those, and this sweet this sweet dividend just keeps rising because this price keeps going downtown to where? Yep, Chinatown. So let's look at it though. We may need to protect our booty just a little bit on it because we're at an 85 right now, and that's only 1 week away. So let's see what we have to do to roll that position. If we rolled that position out, what would we be looking at to do? We'd need 375 per contract to cover us, right? So it's $375 to get out of that position. And we'd be able to roll it to, what was it at? 85. So we'd be able to roll it down to the 84. So it'd be a buck down and another week out. It'd be a buck down and another week out, and we would take some premium. But what if we go, okay, so that's $4, right? So what if we go out another week and it's $4.55? It's $4.55, but we could even roll down another dollar bill to 83, which would put us right around where it's trading now. And it should be, I would imagine, it should kick back up just a little bit next week. But we don't know. We have no idea. So we're just trying to add some downside protection, because otherwise we'd mop up and buy a bunch right now. But I have a number of put contracts out in the ether that may want to float my way, and I don't want it floating my way at $85 a share when I could buy it today for the low price of $294. So let's look to rolling it out to March 31st just to see what it does at $83. And then we'll still put $120 or close to $120 into our pocket right now. Let's go with 28? Can we get a little 28 action? 112. If it keeps going down, well, you got to protect yourself on both sides. Release $800 in collateral because we are rolling down from $85 a share to $83 a share, and then trying to also add $112 to our pocket, and we've got them all filled. So there's $112 in the green to the pocketbook, and then we added a little downside protection by rolling out $2 per share. So ultimately saving ourselves $800 because that was 4 contracts. So on paper, that's an $800 downside protection right here. And when? Right now. So let's take a look back here and see what's happening. Hot stuff. What's happening? Hot stuff. You can't talk like that. I think that's like racial appropriation. I don't think it is. That's just a quote from a movie. But we keep running lower. We've lost another couple grand right before our very eyes. But again, that's paper money. Is it all money paper? No, not really. The reason that we have been taking it on the chin is if we look at our holdings, they are, they're based on a bunch of, maybe my faulty wiring that happens up into my brain, because for some reason I do have, it's probably because of the way that I grew up, with, probably on the lower side of the middle class. So I had a bit of I have a built-in scarcity mindset that I battle all the time. I believe in all the abundance in the world, but then there's this subconscious scarcity mindset that definitely plays tricks on me, where I end up like, I gotta get a deal. It's like when I saved the $3 on the A&W root beer yesterday at Meyer. That put a big smile on my face. So I'm thinking, I bought a bunch of these on what I felt was a sale, right? Like I thought I got a great deal on Ford and on AT&T and Verizon and Intel. And what's Intel done since I've had it? I mean, it's showing that it's up right now, but it's been a dog since I've owned it. Same with Walgreens. Bank of America is still done okay with me, but right now it's down, so it could be a dog. Pfizer, look, that's my biggest position, and it's my biggest dog. Let's take a look at this. Bow, wow, wow, yippee, yo, yippee, yay. Look at my average cost, 46.20 on 2,400 shares. And if you look at, okay, well, that's a current market value of 95,000. Yeah, but what's this? Total return is almost 16,000 in the red. It's not a laughing matter. What did Sparkle tell you? Oh, I forgot about that. She did say, rule number 1, don't lose money. Well, what's rule number 2, honey? Well, rule number 2 is don't forget rule number 1. So we've taken it on the chin with Pfizer. A lot of our holdings have been, the bow wow wow dirty dogs, but we'll be fine because that's still 2,400 shares of a very good company. Let's just check out the Pfizer right here, just for fun and entertainment. If you look at their grades, dividend safety. Okay, so we got attracted to it because it's what they call a dividend yield trap. It like opened right up for me. They're like, hey, we know you're new to dividends. Come on over here. Look at all the candy we have, little boy. So I'm like, oh, candy. I like candy. So I went over there and said, hey, 416 yield. So $1.64 payout, right? $1.64 payout annually based on their quarterly dividends, well protected with only a 24% payout ratio. So if you get out the abacus and you do it's $1.64 a share, and then I multiply that by the 2,400 shares, that's almost $4,000 a year just for sitting on my hands, because the dividend payout doesn't go lower as the stock price goes lower. Not at all. In fact, Pfizer likes to raise their dividends. So this can continue to go down, which we don't want it to, by the way, Pfizer. We want you to make a comeback. But the dividend payment doesn't go down because it's based on shares, right? So it's $1.64 a share per year. So the share number that I have of 2,400 shares of Pfizer, that isn't changing unless I start to sell them off or they're called away, because we do have calls out on all of those. Oh, wait, I don't think I have calls out on any of them. Hey, it's up today. It might be an opportunity for you to get at least some dollar bills on Pfizer. So we may look at that later, because I know I'm getting a little long in the tooth on this conversation. But what I wanted to show you is dividend history. So on my 2,400 shares that currently is underwater by $15,000, it's an unrealized loss, right? When I collect dividends, that's a realized gain. That's real money that goes into my pocket. The same with the premium. When I sell premium, that's real money that goes into my pocket. So let's take a look at Pfizer and their dividend history. First, we'll see that they have paid out dividends for 33 consecutive years. And in those 33 consecutive years, 12 consecutive years, they have grown their dividends. So what that means is when we look down here, we travel all the way back into time. Wow. Let's even go back into the old dirty days of the real estate crash and the economic crisis. They called it the Great Recession. If you look back here, let's see, all these years, 2002, 2001, 2000, and there was some carnage in 2000, but look what their dividend has done. So it was 9 cents, 11 cents, 13, 15, 17, 19, 24, 29, 32. And then they're like, wait a minute. There's that Great Recession. Wow, wow, wow. So they cut their dividend in half here. So I guarantee if we pulled out the big old chart, we would see what their stock price did here, which would have retreated because shareholders would be like, wait a minute, you're paying us all this money, and then you're not. So that's always the risk, and that's a risk you face with any dividend paying stock, especially as we do still face the real risk of recession this year and even next year. So from there, though, they're like, hey, we're getting back at it. Sorry, guys. 16 cents, 18 cents, 20, 22, 24, 26, 28, and then all the way up to where we're at right now, which they just raised. Okay. So we put these dollars in our pocket just a few days ago from Pfizer, and it was 41 cents a share. Okay. So that's what we have, that 41 cents a share. That, as you can see, their pattern, that will hold all year. And then probably in January of 2024, they'll raise it another penny or so to keep their consecutive streak alive, because these CEOs, they love these kind of numbers. They have egos too, just like me and you. So it's not, even though I'm down to 15,000 and I'm laughing about it, it's because laughter through tears is my favorite emotion. No, it's actually because it's still an asset. This is still a company that I believe in. And even though all their COVID cash is going to dry up because, less and less people will be getting the vaccine, they're still going to have a yearly vaccine. You know that. You're almost guaranteed that. It'll be kind of like a flu shot. So even though we're down 15 grand on that dirty dog, we still don't mind because we can sell. In fact, let's go back to it. We can sell covered calls and we can collect dividends, right? Let's take a look, because I don't think I have any covered calls out there, do I? Probably because I was still crying about the stock continuing to fall and crumble right before my very eyes as I sit on an average of $46.20 a share. Yeah, there's no positions I have open. So let's just take a look at what numbers could be, because they are up a measly 10 cents today. So that, the easy rule of thumb on puts and calls is you sell puts on red days, you sell calls on green days. Okay, so not the band, I'm talking about the market. So you see we're green right now. So if we trade the options on Pfizer, and let's say we looked out, let's look out to like, because you're going to have to go out a ways to try to even get close to that 46.50. I'm in on this, man. So if you go out to the liquidity of the third week of April 21st, so the third Friday of every week in the options market is going to provide the most liquidity, come-ins and go-ins, puts and calls, because a lot of stocks only trade once a month, and it's always on the third Friday. They expire on the third Friday of each month. So see, if we go out here, the only way to protect our position would be to go here, which would then give us that upside of $1 a share. So that'd be $2,400 that if we had our shares called away. So if we went into the math, right, and we actually wouldn't do that because when's the next dividend date? We'd have to play it strategically, which I don't normally do, but I'm starting to try to I'm trying to think more strategically on these trades, to think out a little bit further with my bumbly mind. So if you look at their history, their next ex-dividend date is going to be in May, okay? So if we've come this far, it's like my brother told the team when we were at a softball tournament many, many years ago, men's softball league. We were on a roll, and then we all went to lunch, and he's like, hey guys, we've come this far, we may as well win it. So we were all laughing because it's like, well, that's obvious, Captain Obvious. That's why we're here, to win it. But me and him still use we use that quote all the time still, to laugh. We've come this far, we may as well win it. So if we were to be strategic, we would trade outside of this ex-dividend date, which then would also give us an opportunity to collect more premium. So let's just look at the math. So we need to own it according to this, and it's not going to be exact, because if you look at the year before, it was May 6th. The year before that was May 7th. Last year was May 12th as their next ex-dividend date. So if we just planned on looking to May, and they may not even have May options up on the board yet for Pfizer, but we'll look right now just to see. We'll take a look at it now, because if we look here, that's our first number to protect our investment, which was we're 46.50 in. So we'd make $1 a share there if it did get called away, if those 2,400 shares were called away. But if we look at the premium, it's 4 cents. Okay, it's still way more than 0 cents, right? But if we look out and see what we can do, so we can go out and protect ourselves in two areas. One would be being on record for that next dividend, right? And possibly catching a little profit. So now it went from 4 cents to 11, right? So it went from 4 cents to 11. So if we just did this for fun right now, fun and entertainment, and then maybe even profit, if we went out to 47.50 now, right, and we collected 11 cents per contract, and this is $1 above, so we're at 46.50, what our cost is. So let me write that down so my elementary brain can think this through. And then if these shares were called away at 47.50, that would be $1 profit times 2,400. And we'll get the abacus out in a minute. So there's $2,400 bills. And if we did just go through with this trade right here and right now, it's saying we'd have a high likelihood to fill at 11 cents. And we have 24 contracts, right? So that would be $264 also. So we would collect $264 and pass go. And then what did we say was the quarterly? So it's a 41 cent quarterly payment on the dividend. So we would lock in that next quarter's dividend at 41 cents a share, right? We already did the math once, but let's do it again. We'll do it again like we did last summer, 2,400 shares. So that's $984, right? So it's $984 that we would put in our pocket, along with we would add the 2,400 from the $1 a share profit per share at the 47.50 strike price, plus the $264, right? So there would be a profit, a positive profit of $3,648 on an asset that we're currently upside down. But again, we already claimed our money back as part of that per share profit. So we would be in the green and in the positive. So you want to go ahead and make that trade now, or do we wait? Do we wait for Pfizer to bounce more? Now, there's no telling what Pfizer is going to do. It could bounce to the moon, and then we're in trouble because of the FOMO. But we don't suffer from the FOMO here at the Wealth Snowball. In fact, we prosper from the LOMO, the love of missing out. We want to just be cash flow and we want to be green because we got to protect rule number one: don't lose money. Otherwise, Sparkle slaps me around and slaps me silly, which is what I deserve in that scenario. So right now, and what are we doing overall? So overall, we got the Dow up just barely. NASDAQ's taking a beating, and then S&P's nearly unchanged. So unchanged my heart. Say you love me again. Hey, it almost sounds like Cher a little bit. That's weird. Oh, that's weird. So is there going to be more downside pressure on stocks over the next couple of weeks? I think the answer is, unfortunately, yes, because as we get closer and closer to the Fed, potentially and maybe statistically more likely raising the rates by 50 basis points, the more pressure is going to be on the economy, period. So sometimes you have bad news is good news and good news is bad news. Like today, you get a great report that the economy adds what? 1 million jobs. The economy adds 311,000 jobs, and that's actually bad news, right? Because the Fed wants that number to be a little more flat. So we added 311,000 jobs on a prospect of 200 and some thousand. So we were coming in hot on that number, and that's actually bad news. Then we get bad news on this side because unemployment ticked up from 3.4% to 3.6%, but then it actually becomes good news. So it's just a weird market we're in right now, and I have no idea which direction it's going to go. So what we'll do is the one direction we know, which if that's your favorite band, you need to click off the channel. That's mean. Is that even a band anymore? Coco, tell me, because that used to be her favorite band when she was a wee little girl. One Direction. Can we get it filled at 11? It's got a real tight bid and ask, so that's certainly possible, and we're on the high end of the ask. So if we got 24 contracts and we walk away with $264, that's $264 that I didn't have, and it's protected by $1 on the upside at 47.50 on the strike price, and it's out 70 days, which means we will then also capture that next dividend. So it's, if my thinking's wrong, let me know. So that got filled. There's $264 bills. Thank you so much. And I've just been babbling on, and I'm starving. You ever heard of that intermittent fasting? I'm trying to drop a couple of gut points off the old midsection here before we go to Mexico. We got spring break in Cabo coming up 2 weeks from tomorrow we leave. But guess what? Lady Tanzala and Maya Coco, who just got here yesterday, they leave tomorrow for Playa del Carmen in Mexico. So they'll be gone, I think, 6 days. So I'll be on my own, so no telling what's going to be going on around here. Probably a lot of drinking beer. Well, not at all. I got to get up and make sure kid 3 gets to school on time. So there we have it. Nice little trade. Cleaned up the portfolio just a little bit, but no telling what it's going to do because we just are not having a great day as far as the paper losses are concerned. Credit spread still in good shape on the Qs. Credit spread still in good shape on the SPY. This, we did roll that out, but it's still showing that it's there, but we know we rolled that out for more fun and profit. So that's what we have. I may come back because I need to look at Signature Bank, but I want to look at it more closely because it's just taking it on the chin today. Let's see. Is it still getting steamrolled? Signature Bank of New York. It's getting steamrolled. Oh, yeah. Whoa. It's like I actually took my breath away just for a moment. And you know why? Because if you remember, if you watched it, if you tuned in to one of the Premium Hunters episodes, Signature Bank was one of the companies that we sold puts on, and we sold them at $90. What's that funny? Remember rule number 1, don't lose money. So we've already adjusted one. We're going to have to go in and adjust the next. But at some point, I'm telling you, this becomes a steal. It becomes a bargain. But what do I know? I need to look at the numbers just a little bit more because they're obviously making a run on the bank as far as this these stock prices are concerned. Because the Silicon Valley banks, their crisis is rattling America's biggest banks. Well, this is not America's biggest bank, but it is what they call a regional. And their balance sheet looks good. Yeah, they have some crypto exposure, but they've already been unwinding it. That should be good. It's going to take some of the revenue away. But I think they're just caught in a really bad undertow here. So we're going to have to look at rolling out our put positions so we're not caught too far with our pants down. And we may even consider, just like on a gambling Friday, we may even consider buying 100 shares, just looking for, some sort of a bounce early next week on that, but it could just go down to zero and you'd be out that money. That's true also. So I will check back soon. Until then, I'm going to go eat some food. My beautiful bride, she made me a wonderful breakfast casserole, eggs, cheese, spinach, either spinach or kale. She alternates between those two, and mushrooms, and it is absolutely delectable. And what I'm able to do is just heat that up each morning for breakfast for several days. That's how sweet she is. And I'll miss her. I'll be missing her. Look, it keeps going down. I'm crying through my tears again. I'm getting all excited because it's Expiration Friday. I will talk to you soon. Subscribe, like, comment, share it with some lovable friends. Not anyone else, just lovable people. And I'll see you in the next video.